Stocks, bonds, and cryptocurrency all struggled as inflation rose and the Federal Reserve continued to raise interest rates in an attempt to bring down spiraling consumer prices. The S&P 500 index is down roughly 19% since the start of the year, while the Dow Jones Industrial Average is down roughly 9%. The worst losses among the major benchmarks were concentrated in the tech-savvy Nasdaq Composite, which has dropped more than 30% since January 1st. With the economic in stasis and the Fed signaling more rate hikes on the way, markets face a very different backdrop than 2022, which was marked with resilient growth, high inflation, and hawkish policy. Morgan Stanley Research's chief cross-asset strategist, Andrew Sheets, wrote in the firm's 2023 outlook, "Stocks will continue to slow down in 2023, and we could see more market lows like the ones that rattled investors this year," according to experts from JP Morgan. This proverbial snowball should continue to gain momentum next year as consumers and companies more meaningfully cut discretionary spending and capital investments. Lakos-Bujas, global head of equity macro research at JP Morgan, said in the firm's 2023 markets outlook. The silver lining? An eventual Fed pivot could push stock prices up at the end of the year, Lakos-Bujas added. He expects the S&P 500 to reach 4,200 points by the end of 2023, a bump of about 8% from today's levels. Morgan Stanley analysts agree that the index could reach that level if the economy performs unexpectedly well. However, their main forecast is that stocks will end 2023 at around 3,900 points, which is just slightly higher than the current level. The stock market has been extremely volatile this year, with intraday swings of more than 1% occurring at a frequency not seen since the Great Recession. The greater the size and frequency of price movements, the more volatile the market. While stocks are expected to struggle next year, experts believe bonds will make a comeback. Bonds, the biggest losers in 2022, could be the biggest winners in 2023, Morgan Stanley analysts say. Meanwhile, Vanguard analysts now predict that US bonds will return between 4.1% and 5.1% per year over the next decade. They predicted returns of less than 2.5% a year ago. The reason for the turnaround appears counterintuitive. 2022 was a rare year in which stocks and bond prices fell concurrently. This is bad news for stocks, but it could be good news for bond investors because falling bond prices mean higher yields. Higher yields imply higher income for investors. While the prospect of another difficult year in the stock market can be frightening, investors should brace themselves to stay the course. Financial advisors typically advise continuing to invest even when the stock market is underperforming if your circumstances allow. This strategy will ensure your success and prevent you from missing out on the recovery. Taking the long view can also help to alleviate any anxiety that comes with a volatile market. According to Philip Stryle, head of capital markets and asset allocation for Morningstar's investment management group, investors have reason to be optimistic. The 2022 downturn has set the stage for a significantly improved long-term investment environment, he wrote in a 2023 outlook this month. If you're new to stock market and want to know more about it and how to get started, then click on the video you see on your screen to check it out.